All right. Welcome, everybody. Today, we're going to be talking about the business case, tying tenant efficiency to NOI and asset value. So this is obviously particularly in the triple net space, and we'll explain the context and everything. For those who have not attended one of Enertiv's webinars, we try to keep these short, 25 minutes, get you in, get you out, teach you something, and have you go on with your day. I will stick around for 5 minutes after the presentation if there are any questions. And obviously, you will get a recording of this afterwards, and feel free to respond or reach out to me if you think of any questions in the future. Great. So with that housekeeping out of the way, let's dive in. All right. So Enertiv has been around for over a decade. We can solve a lot of problems in commercial real estate, but particularly for the triple net lease space, we, years ago, were approached with a problem. We submit to GRESB, or we have state or municipal benchmarking requirements that mandate us to report on the utilities and emissions from our buildings, but the tenants pay the utility bills, and therefore we don't have access to the data that we're supposed to report on to investors and regulators. So currently, we are asking our tenants to share their bills. Most of them ignore us. Some of them comply. Often it takes many, many follow-ups. Some of them just flat out say no. We've tried, to institute getting green leases in place. It's always a negotiating point. We've gotten them in place in a good amount, but it takes a really long time to turn over the whole portfolio. So that was the original problem. Enertiv's metering technology and software capabilities can make this problem go away. We can deploy sensors or use software to capture this data directly and fulfill those reporting requirements. The unlock was that we recognized that the data that we're capturing, it's tenant consumption data, is valuable beyond reporting. And that's what we're going to talk about today, because there's a continuing disconnect between what landlords believe and what tenants are saying and what they believe. And that's what we're going to highlight today. All right, so we'll talk a number of different areas, particularly the how and the what, but I wanted to cover the why first. So what is the bottom line value to a triple net lease owner in making their space more energy efficient when the tenant pays the utility bill? We'll cover each of these in depth, but I wanted to cover all up front. So one, lowering the total cost of occupancy matters, right? Tenants don't just look at rent. If the space has a lower TCO, you can lease it faster. Who doesn't want to lease their space faster? Two, differentiate your product in the market. For the majority of space that's going to be leased in the future, the companies that are going to be leasing those space have their own carbon reduction targets. So aligning there can be a factor in leasing decisions. If the tenant's already in the space and there's a renewal coming up, demonstrating that you have saved them money and brought value to the table is a factor that can be brought up during renewal negotiations. Many triple net lease landlords are bringing services to their tenants and generating a novel revenue stream beyond rent. And then kind of downstream future-proofing the asset against state and municipal fines. So if you want to dispose of the asset in the future, you won't have to take a hit for the buyer to underwrite upgrades to fulfill energy regulations. So let's talk about each of these in depth. Before we do, some important context. So tenants in triple net lease spaces have always paid the bills. The difference today is that energy prices are skyrocketing. Everybody knows that there is a data center construction boom happening currently. Data centers consume inordinate amounts of energy. It is causing energy prices to rise precipitously. This, along with general electrification of our economy, means that over the last 5 years, energy prices have risen over 29%, outpacing even our high inflationary environment. And that's after, a decade of stability there. So this is not in a bubble, right? There are macro factors that are changing the equation and how tenants think about their operating expenses. But we hear this all the time, right? Rising energy costs, that's their problem, right? They're running a business, they sign the lease, we don't pay the bill, we don't get involved, we don't want to. Or our tenants, they're just warehouses and it's just distribution. They actually don't consume that much energy. And it's fair. These are fair arguments, right? Like, unless the real estate portfolio is driven by a strong sustainability mandate, it's often seen as a violation of fiduciary duty to make investments that you're not going to benefit from. The point of this webinar is to make the argument that you are going to benefit from it, partly due to the changes in the macro environment that I just talked about. And like I mentioned, right, increasingly, tenants look at the total cost of occupancy, not just rent. So while this data is a little old, this is the latest I could find it from Newmark and NCREIF, but while there's been healthy rental growth, which is great for landlords, there's also been high increases in OpEx and utilities alongside that. So the net impact to the tenant is even greater than the rental rate increases that landlords are capturing the upside from. Now, what this means is if you can make an investment in your property, lower that total cost of occupancy, lower the utility consumption through efficiency, you can go to market with a lower TCO and likely lease the space faster. Or, and I think this is more rare, but conceivably you could go to market with the same TCO and capture the upside on the rent. I want to make a point too about scale here, right? The investment necessary to blunt the increase in OpEx and utilities is a fraction of the cost of the OpEx and utilities. So, if you could make a 1 penny per square foot investment and knock off 10, 20, 30% of energy spend, it makes a big difference for the tenant. So the scale is important here too, because the investment compared to the cost reductions are great. There's a healthy ROI there. All right, so that's on like, who doesn't care about money, right? Like, generally in the market, it's better to go to market with a lower TCO. But that's just one of the factors at play. Through our business, we get exposure to many industrial tenants, and there are obviously the Amazons and the FedExes and Home Depots of the world that have investors that require net zero commitments. A surprising number of smaller non-blue chip tenants do as well. JLL just released a study of focus specifically on industrial space. They estimate that 65% of future demand for industrial space will be, like I said, leased by companies that have a carbon reduction target. In some markets, that number is way higher, right? In Toronto, 85%, New York, New Jersey, 75%. The vast majority of the space that's going to get leased is going to tenants that are actively looking to reduce their emissions. And like I said, I hear often that, well, that's all well and good. These tenants, they've got it all figured out. There's nothing we can do. You couldn't be farther from the truth. Even the blue chips don't have it figured out. It is a real opportunity for landlords to differentiate their product. All right, so let's talk about some real examples. So this is a industrial warehouse, single tenant, leased to a Fortune 500 company, probably Fortune 10 or 20 company. The example here is really exciting because it actually is direct value on both sides. So in this scenario, shadow metering was deployed to automate the GRESB reporting and increase data coverage. Based off that data, there were operational insights that were brought to the tenant. Your base load can be reduced by the equivalent of $57,000 a year, and here's how you do it. If you go about doing that, you're also going to have lower peak demand charges to the tune of $19,000. So that's, hey, tenant, how would you like to save nearly $80,000 this year? Sounds good. Oh, and by the way, we are in a utility jurisdiction that has a demand response program where they'll pay you $41,000 in cash to enroll in the program. It almost never gets, you almost never get called on to curtail your load. And even if you do get called on and you don't curtail your load, there's no penalty. You just won't get this cash. So it's a no-brainer, right? Imagine going to tenants with this kind of value, and at the same time, using the data to perfectly hone in that you could basically rent out the space in a community solar strategy and get an additional $46,000 a year of rent from your roof. So this is a scenario where tenant benefits when the renewal comes up. It'll be a negotiating leverage point, and the landlord directly benefits more than paying for any cost of shadow metering, which we'll talk at the end, often gets passed down to tenants anyway. All right, so here's another case study of one of those larger blue chip tenants. So very similar setup, right? Single tenant, big facility. In this scenario, about $135,000 worth of savings. Demand response program worth $34,000 in cash. They have their own requirement, well, they have their own goals to get what's known as a BOMA Best certification. So this tenant, for all their spaces, they're trying to achieve this certification where possible. It's usually a huge hassle to get this done. You have to verify a lot of data, and you have to prove that you've done certain things. However, with shadow metering, a lot of that is automated, and you can do that process easily. This is actually done through one of the actual certification paperwork is done through one of Energy's partners, similar to the solar I mentioned a moment ago. But basically, what happened as a result, that this was their first exposure to Energy. Now this tenant is going to their landlords in other leases and saying, we want this technology in our space because we've benefited so much from it. Right. So now it's the flip where the tenant is saying, landlord, contract with Enertiv, pass it down to us. We're okay with that, but we want this technology in this space. All right. And then after two blue chips, I wanted to give an example of a non-blue chip. This is a tenant. They're in a multi-tenant industrial asset. They lease about 50,000 square feet. They do product testing. That's their business. And they are heading into a renewal in 2026. So landlord and Enertiv together were able to go and say, there are $38,000 worth of optimizations. And this was happening, the asset manager was so excited because this was happening just as renewal negotiations were kicking off. It was identified that the rooftop units, they could be optimized, and really you should invest in better controls. Now that's most of the operational insights we've talked about don't require any investment. This one would. But the sustainability team for this tenant, and again, like they do have a net zero goal, but they're not a blue chip company. They lease, smaller spaces in multi-tenant facilities. They said, do what you can without the investment. And the facilities team went to each rooftop unit, manually updated it according to the data's recommendations. And in a week, they saw an 8% drop to their total consumption. This is a fraction of the total potential value, but the fact that this was able to happen so quickly and in parallel with a renewal meant that the negotiations are ongoing, but asset management was able to quickly get an agreement to move the rent to market rate. They were below market rate, and they've agreed to get up to market rate. So big win all around, right? Everybody wins in this scenario. All right, so I've alluded to a couple times, whether it's solar or getting a certification or doing demand response. These are not Enertiv core competencies. The insights and the operational, the optimizations are Enertiv's core competencies. Those other services insights are delivered through our partners and our vendors. And transparently, we get a cut when we're able to say, hey, we have data that indicates your service would be valuable here, and their service is deployed. Enertiv has set up with numerous landlords to revenue share in that cut. So basically, hey, tenant, you are eligible for $40,000 in cash from the utility. Do you want to enroll? Great, you do. Landlord gets paid when they say yes. Now that's another win-win, right? Where we are generating additional revenue while providing a better product and a better service to our tenants. Okay, last point here. We're at the 20-minute mark, so we're moving nicely. There are numerous states and municipalities that currently have energy benchmarking requirements, and the details vary here. Sometimes they carve out industrial, sometimes they don't. But the number of states and municipalities that have put this into law is a fraction of the states and municipalities that are currently working on similar regulation. And in no scenario do these regulators plan to stop at benchmarking. Benchmarking is always the first step to building energy performance standards. Now, whether that comes in 1 year or 5 years or 10 years, it's coming. The reason they're benchmarking all the buildings is to set the baseline to mandate emission reductions. If the plan is to dispose of the asset over any of those time horizons, having exposure to building energy performance fines, I hesitate to use the term stranded asset. That's something that has happened certainly in places like Europe, where the regulations are much steeper. But regardless, right, there is going to be a discount for buildings that are on the hook for significant fines through these regulations. Now, added benefits, right? Even for where there's only benchmarking regulations in place, automating, the reporting process just reduces friction between the tenants and the property managers, right? Going back to our first slide there about chasing them, that's no fun for anybody. We talked about avoiding fines, and we talked about future proofing there. All right. So final thoughts. Thank you, everyone, for sticking with me. So keep in mind, right, the game has changed or is changing and will continue to change. Unless you think that AI and data centers are not here to stay, energy rates are going to continue to rise. It's going to have a increasing impact on how tenants think about their spaces. Meanwhile, despite political headwinds at the moment, companies do not set, they might take down a DEI page on their website, but they don't set multi-decade targets and change those based off the political climate. They might talk about it less, but tenants and occupiers are desperately trying to decarbonize their own assets and are unaware that there are landlords out there who want to support them in their goals. I mentioned this, but shadow metering is typically a pass-through cost, especially when it directly benefits the tenant, right? If it's purely for reporting, maybe you get some pushback. If you can say there's a direct ROI for you, it's a much easier sell. And just from like a deployment and concern about the invasive nature for tenants, installations are typically performed outside the tenant space, which is great, and typically don't require shutdowns or disruptions to their operations. So important things to consider. With that, we're at the 24-minute mark, so perfectly on time. Like I said, we're all done here. Get back to your day. If you want to stick around and ask any questions, feel free to drop it in the Q&A now, and I'll answer them. Likewise, feel free to reach out to me, commonly@enertive.com, if you have any follow-up questions in the future.